Yo, B, let's go.
You may have seen the clip and maybe heard word of mouth, yet another podcast. Man, what could it be about? Is it truth or opinion? A couple of contradictions. We're here to challenge tradition and twist your vision. So we set on a mission to bring you rebel wisdom.
Welcome back, everybody, to another episode of Rebel Wisdom. I'm Julian here with my boy B. And today we're going to be talking about IBC, also known as infinite banking concept. So it'll be a money-heavy episode, as we like to sprinkle these in, usually every other week or so. But I don't know, me and B, I think we talk about it quite a bit. I don't talk about it too much with a lot of my other friends, and a lot of them are like pretty financial minded, I guess. But I think it's a fascinating concept. And I guess to just kind of baseline it or define it, I'll give how I think about it, and then I'm going to pass it over to you to, usually we like pull it up and read it off. We can do that too. But when I think of infinite banking concept, I think, or how I understand the premise to be, is to kind of like eliminate the usage of banks in your life. So primarily it targets the whole life insurance in a way that you can build a cash value where you can pretty much borrow from that and eradicate the usage of bank or minimize the usage of bank in your life, which is hence the term like infinite banking, because you can just like kind of rinse and repeat this concept, I guess. And that's how I just like to think about it. What are your thoughts surrounding,
No, it's.
or
I
like,
think.
I guess like what it means to you?
Yeah, I think it's pretty much exactly what you said, and I probably like what you said better because it's like you have it in your own words. Because I've watched these videos, I read books on them, and then all I say now is what the key
Yeah.
phrase is and the lingo that they use.
I
So
think that's good too. So like, tell us that. Yeah.
they instead of how infinite banking works is basically traditionally you go work, you get a paycheck deposited into your bank account, and then you can either spend or save. Those are the two things that you can do with money. And then saving obviously includes like investing and whatnot.
Yeah, sure. Okay.
Spending also includes like giving and stuff like that, right? But where infinite banking concept comes in is instead of paycheck to bank to spend or save, you just insert paycheck to bank to whole life to spend or invest or whatever. You and then it's not, you can go like completely aggressive and do 100% of your income to this, but I don't think that would be a wise choice. But usually, you put in a good chunk of your paycheck in the
Right.
form of monthly premium. It doesn't have to be paycheck, it could be anything. For any form of money coming into to you. And then you basically transfer that money monthly or in a lump sum into your whole life account, and your whole life account cash value grows at a steady rate. And then because as it's growing, you can take out a loan against it, and the interest goes back to you, and then you can use that loan for everything. And the premise behind it is like, I think we talked about it in previous episodes where I think you can make it so that loans are not in your life, debt is not in your life. But for
Elaborate
majority,
on that.
like a Dave Ramsey style, like you don't take on any debt, you just live
Okay. I
debt
thought you were
free.
saying something complete. Got you. Got you.
Where if you're in that camp, like this is not for you, right? It's just not. And but other camp is like it's in life, you're just you're gonna come through debt, and it's okay.
Yes, it's natural.
Where like car loan is a big one, like a house, like a mortgage is a huge one, right? Or any investment, business opportunity, you generally take out loans.
Yep.
And that's where the infinite banking concept comes in. And yeah, that's, I'll leave it off there, and then I'm sure we'll talk about Dave Ramsey and stuff more later in the episode.
Yeah, that was a good deeper dive introduction. So yeah, I appreciate that. And then just to just to get out there, get this on the record. Are you? So we'll stay if we support or not, and then we'll kind of dive into it. Then I'll have a question for you that I'm gonna save, I think, towards the end. I think it'll make more sense kind of after we've talked through some stuff. But are you a supporter of the infinite banking concept?
Yeah, I'm a supporter. I'm a supporter in terms of the how it works and what it does. I done the math. It works. It's legit.
Got it.
But at the same time, I don't have one
Right.
for the cons that comes associated with the infinite banking concept. Because when you look at I don't want to say famous because the IBC infinite banking concept, IBC is so niche within the financial space.
Yeah.
It's very not known about, I guess. But at the same time, like all the smart, rich people and rich families use IBC, and just like it's just like a little bell that rings, and it's like, okay, they're rich and they're doing this. Let's see if I can try to do it. So I'm a supporter of it.
Okay.
But I haven't started because there's associated cons with it.
Yes. We can get to that stuff. Yeah.
One thing I don't appreciate is all these content creators. I don't want to say all these, but certain content creators, and especially in the short term, like short form content. We were talking like before the podcast, we were talking about how short form content, like there's so much stuff left out of, like the context is left out, where I just hate the message that certain short form content sends, I guess.
Yeah.
But this is definitely the case for me for IBC because they paint IBC as like a get rich quick scheme. It is the completely opposite.
It's not
quick at all.
Yeah.
But often things, when something takes a long time, it just usually better or good.
It's a good just little nugget for life. It's like anything, what was that quote? Anything worthwhile is worth work. Like it's something you got to be steady, consistent with to reap the benefits. So I didn't even realize in asking you that question, do you support it, could have been interpreted two different ways. I'm glad you distinguished, because I guess also believe in it, and you know more about it than me, but I also don't have like a policy or anything, which that was a question I was gonna, maybe we can circle back to at the end. Maybe as to why, like kind of what we're thinking in our lives or how our lives are structured, why we either don't have it or want it or don't want it, and we can circle back. But from I'm trying to think from like the everyday average person, right? Like why, now we can kind of maybe dissect IBC, I guess, a little bit. And I'm thinking like why. So it's obviously we support it. It's appealing to us to some extent. And some of the surface level things I think that are kind of like cool about it are like, when I'm just trying to think, when you go to take a normal loan, like, right, like what are some of the things you need? And you need to get like pre-qualified or qualified or certain credit score, whatever. Whereas this is like you're essentially borrowing from yourself, like what you've been pouring into this policy. So the barriers to borrow, I guess I can say, are so much less, you know what I mean? Like there's not all that anxiety or hassle around trying to see if you even can borrow, or the bank tries to evaluate you typically as a borrower to see if you're worthy, or like your credit worthiness, whatever. But in this case, it's like, hey, I'm kind of taking from the pot of money, which is aka the cash value that I've been building up. So it foregoes a lot of those barriers. Just off the back, I think that that's pretty cool.
Yeah, well, definitely. I think the idea is this is so within the Rebel wisdom realm because it literally forces you to think of money, the flow of money in a different way. And can I go ahead and just try to explain more into detail from what this thing is before we get into the loans?
Yes.
So, infinite banking concept uses a whole life insurance policy, not just a regular whole life that, you can just go get at a regular bank. You have to get these very customized by infinite banking concept, like agents that understand this stuff. And there's there's notable people in the space like Chris Nagle, Mr. Burr. Those are the two that I kind of started watching and learned from. But basically, you design a whole life insurance policy to where you make the premium really, really, really low. So if you make the premium low, that means your death benefit goes down, which is okay because that's not the point. It's a perk of the IBC, but it's not the point of the IBC, the death benefit. It's just something that's like a cherry on top you get at the end. Or maybe not you.
You don't get.
Yeah. But
somebody will get
kids
it.
or someone's gonna get it. Right? So basically, the rule of thumb that they use is if you're below 30, you multiply by 15. And then if you're over 60, you also multiply by 15. But if you're between 30 and 60, you just multiply by 10, and that's your minimum starting amount that you have to pay each month in premium. So for example, how old are you?
I am 31, good sir.
You are 31. So you do 31 times 15 or 10.
Yeah.
And then that's $310 to get the IBC policy started, where it's like effectively working towards you, because you have to, like I say, you have to customize these things, right? Mm-hmm. You should be putting minimum of $310 a month, and that's just to cover the death benefit.
Yeah.
That if you just did that, like IBC is not for you. That you're not taking benefit over, right? So where the IBC comes in is instead of paying $310, you can pay. There's a there's an upper limit based on your income and your policy and stuff like that. But let's say you put in, we'll make the math easy. Let's say you put in $610. So let's do 620. So out of the 620, 310 is going towards your death benefit, and the extra 310 is going towards your cash value. Mm-hmm. Right? And so basically when you put in $620, whatever you pay in premiums for your death benefit, for today, you can kind of think about it as it's gone. That's just like your payment to operate this thing. But you get the death benefit too. So it's life insurance. But anyway, with the cash value that you put in, in the example, we put in $310. You do that every single month, obviously. And that money is getting compounded around 6%, depends on the company, around 6% guaranteed, right. Which when you hear guaranteed, it's like, oh, that's like risky. Like there's some red flags, but basically what they're doing is like these life insurance companies, they hire very smart people to work on risk management and statistics pretty much. And with what they're saying is whatever the company provides, let's say they provide 5%, right? Mm-hmm. They are so confident that they can make 5% without question in any market environment every single year. We're like, all right, we'll do 5% and no more. Because if then whatever they make, like I'm sure the company just keeps it, or but anyway, so with that, you have money going in every month and getting compounded without question every single year at X amount of percent, depending on what a company you use. And with the cash value that's getting built, so let's just say I'm going to do super easy math. We'll do 310 that you put in a month, multiply by 12 for the entire year. Okay. So you get $3,720. And even though it's compounded throughout the year, let's just say that it's compounded at the end of the year once. So I'm going to multiply that by 1.06 for 6% gain. So now the amount is $3,943. Okay. That's your cash value that you built year one. And from that cash value, you can take out a loan against it. And then the loan that you can take against it is usually about anywhere from 87% to like 95 maybe on the high end of the cash value. So let's just say 90, go right down the middle, right? So I just had $3,943 multiplied by 0.09 for 90%, or sorry, 0.9 for 90%. And you can take out $3,548.
Not too shabby.
So, I mean, with that math, you're like, that's pretty dumb. I overpaid for whole life insurance and I paid cash premiums that I only collected 90% of. But here's the crazy part. The money is getting compounded every single year. So when you do the math, you can do the exact same math on the Excel sheet or something like that, right? Just keep your monthly like cash value investment the same, and just set up fixed percentage rate like 5% or 6%. And what you're gonna realize is when you do this for over X amount of years, over 10, over 15, it's a long process. Is the amount that you put in kind of translates to more money in terms of what you can take out as a loan. So let's say in this case, we can do $310 that you put in month one, right? So, but then with the 90%, you can only take out 310 times 0.9, $279. But in the later years of your policy, just compounding every single year without question, you can, I'm just making this number up. You can put in 310 and you can pull out like 500. And that's just through compound interest, which is a crazy part. And when you take out money, what Julian was saying, like, it's so simple. Apparently, I mean, this guy walked through the process on like a YouTube video once. But like, you literally go in the app, go to the loan section, you put in how much you want to take out, and it gets deposited like in like a couple business days.
I've never seen somebody actually do it. Yeah, that'd be interesting.
Which it's so against the traditional, loan. Yeah. Like the mortgage process is it's probably the hardest loan to get, right? It's so much underwriting involved in getting a mortgage. And even for like a personal loan, I think it was about a year ago. I was spending crazy amount of money on like a real estate project I was doing, and I pretty much didn't have like any cash, and that just made me uncomfortable. So I wanted to take out a good chunk in a personal loan. And mind you, I'm not going to say this amount, but the amount that I applied for, I could have paid back in about 3 months. Right? But the loan, I set it up for like 5 years, right? Just in case.
Yeah.
But mind you, I could have paid it back in full without sacrificing my daily life in 3 months. They denied me.
Yeah.
I was like, how like that
what
makes
were you
no
assessing?
sense.
Yeah, right.
So that's just it's so strict. But yeah, with the IBC, you can just take it out, no questions asked. You can spend it on whatever you want. And as per any loan, they're going to charge you interest, right? But the interest is lower than what you get per year in that dividend form of 6% that we were talking about in that example. So if it's 6%, like your loans might be 5%.
Right.
And if you know anything about money, you're kind of collecting the arbitrage of that 1%, which is benefiting you in terms of opportunity cost.
Yeah.
Pretty much opportunity cost. And the crazy thing is the amount that you get charged is 5% in this example. When you pay it back, it goes back towards your cash value. Yeah. So you're building your cash value. So once you pay it back, you can take out more for whatever investment you can do. And what traditionally with the IBC, what they recommend is, let's say you want to, let's say your account has 60K. And then you're like, okay, I want your cash value account, 60K. And I want to buy a car for 50K. So you go pull out that loan, that money hits your account in your bank account. You go to the dealership. So you would be paying cash for that car, right?
Right.
And then what they tell you to do is you got to figure out what the car would have cost you if you borrowed money. So it could have been, you go to the dealership, you talk numbers, and they say, okay, I can give you a 6-year loan at 6.23%, and your
Right.
monthly payment's going to be this much. And you say, okay, thank you, I'm going to pay
Yep.
cash. But
And
you
just
take
pay
that
yourself back.
number and you pay back the loan with the exact same payment. So you're borrowing at 4, you're paying back at 6.23. So you're going to pay off that loan pretty quick.
Yeah.
And you would think, okay, since the car company, the financing company for a car, they're like, it's going to take, what did I say, 6 years for the example?
Yeah.
And this is another topic that I can talk probably 30 minutes for, but I'm not going to. But those loans, and for like mortgage is the same thing. Those are like amortized loans. You heard I think everyone pretty much knows what an amortized loan is, or if you don't, you can just do a quick Google search. But basically, they're compound interest accounted loans. Whereas the loan that you take against IBC, you can think about it like a HELOC. HELOC is not an amortized loan. It's a simple interest loan.
Yeah.
So if you take out $10,000 and before your first payment hits, let's just say you just paid $1,000 off, the interest isn't charged on $10,000. Your interest is only charged on what you have taken out at that moment.
Yeah.
Which is $9,000 in this case. So when you do the math again, compound interest, the mortgage is going to take 30 years. The car loan that in this example is going to take 6 years. But with a simple interest model that IBC loans are designed for, you pay it down in I think around 5 years. And in terms of 6-year loan, paying something back a year early it's pretty substantial.
Yeah.
Right? Like you're cutting off 1 divided by 6, which is 17%. But you're not making any extra payments. You're doing the exact same thing.
Right. Same thing. Yeah.
And the interest goes back into your account.
Yeah.
And rinse and repeat on whatever your account grows like crazy. And at the end, there's a couple things that could happen. You're going to, at least in today's day and age, no one has the power of being immortal, right? So you're going to die. You're going to die. So that is one thing that's guaranteed.
Yeah.
You're going to die. And then whoever you put as your beneficiary, they're going to get the death benefit associated with the account. And then also by the time you die,
and it's tax-free,
so much
too,
compound interest has happened. Your death benefit is in the millions without putting in any extra money, because the extra money you put in was from the loan that you took out. So you want to take loans out to use money efficiently. And I just keep sidestepping because I was going to say you die and you go into another thing. But the whole point of this is to take out loans against it and go make money with that loan, or make purchase that you would otherwise made with a traditional loan from the car company or mortgage or whatever. Because another thing that you can do with the loan is, back onto the arbitrage topic, I can take out a loan at 4% from the IBC concept.
Yep.
And let's say, Julian, you need money.
Right.
And they're like, dude, I need money so bad, but the banks are charging me 9%, 10% for a personal loan. That's some bullshit. I'm like, you know what? I'm a good friend. I'll let you borrow for 6. You'll be like, oh, hell yeah, dude. Thank you so much.
Yeah.
But I'm collecting 6, paying back 4. So you're now making money off that thing.
Mm-hmm.
Right. So that's a very simple example, but you can, if you're good with money, you can make a lot of money with IBC.
I think lenders do that. I'm sure they do, but I wonder if that's a...
Oh, yeah. They have to. That's how they make their money.
Yeah.
They have to. The banks are in the business of arbitrage. That's why infinite banking.
No. I'm talking about personal. My bad. Yeah, if you people that front people money for real estate and stuff. If you were to do I don't know, just...
Oh, yeah. They can take on money in any vehicle that, they can do that too.
No, I'm curious how popular IBC is, and that's specific example of somebody, instead of like borrowing from a bank, like, getting money from somebody else.
Oh, I mean, real estate is really big for private money lenders.
Mm-hmm.
Yeah, those are huge,
Yeah.
and I think, I mean, when you're dealing with the small amounts, they might just come from personal funds, but again, it's so niche, so I don't want to say a lot of people.
Yeah,
but
I
if you
truly don't. I have no idea.
the people that utilize IBC, like they tend to lend to real estate associated people because
Right.
real estate just kind of inherently comes with debt. It's just part of the business. So it aligns very well.
Yeah.
So back to what I was saying. So at the end of your like this whole IBC journey, right? I guess life cycle. One is you just die and your beneficiary will get the death benefit.
Right.
Second is, let's say you're like, you hit retirement age, you're like 65 and you're like, all right, it's time for me to retire. But oh no, you have no retirement savings besides your IBC. What you can do is you can take out, we'll say 6%. So what the company is giving you in terms of cash value, you can pull out.
6% of your cash value?
Yeah. You know how they pay you 6% in the dividends I was talking about?
Yep.
So now let's just say I start taking out 6% a year from that cash value. Let's say I had $3 million built up. And I had no outstanding loans from it, right? And 3 million, like that's like a very reasonable number. It's not like a crazy number. So let's say I go 6% of that, which is $180K a year. I mean, of course, inflation is going to happen in the future, but that'll be a good chunk to retire with, let's just say, right? So now you have 100K in your account, but then they give you the dividend. So you're kind of like plus or minus, you're evened out. You're not growing your cash value, but you're not also you're not going down either by taking out the loan. And you can have the option to not pay back your loan, which is the crazy part.
Which is insane. It just comes from the death benefit, yeah.
Because with a loan, you are taking collateral against it. You are taking your cash value and you are collateralizing it against your death benefit. Because they know death benefit is a great collateral because you're going to die. You're not going to lose that collateral. There's no way. So you can take out whatever percent or whatever money, right? It doesn't have to be 6%, but don't get stuck on the numbers, but just understand the concept of you can take out money until you die. And let's say your cash value was 3 million. At the end of your life, you lived a really good life and you took out $2.5 million in loans. So you have 3 mil in cash value. You got 2.5 in a loan. And the great thing is, because that 300, you're going to have more in your death benefit. Let's say your death benefit was like, I don't know, $5 million.
But how do you know for a fact you're going to have more in your death benefit?
It's just a rule. You have to follow that rule to abide by like government laws, pretty much.
Got you.
Yeah. So that's where the building phase, like the designing your policy comes into. But okay. So let's say your death benefit is like 5 mil, let's just say, right? Whatever you have outstanding in your as a loan, let's say 2.5 in this example, you take 5, subtract 2.5, and your leftover was 2.5. You don't have to take out that loan. You don't have to pay back that loan. They'll just decrease your death benefit for the next person. So also,
sorry, son.
I mean, they're still getting a lot of money. So you like a lot of people's end goal with the IBC is also retirement. So that's like another way to think about it. And then with the generational wealth piece, you get a chunk at the end to pass on to your kids. So that's IBC in a nutshell. I probably did an awful job explaining it. But I do want to say, for a better understanding, like, I'm not kidding. I had to watch, like, I'm not joking. I probably had to watch, like, 15 to 20, 30 to hour, 60-minute videos
Yeah.
finally be like, okay, I think I understand this.
Mm-hmm.
And I even read a book about it.
I haven't. Yeah, that's what I need.
And I'm like, okay, I think I finally understand it. And not, I don't understand all the nuances because I haven't even done it myself. So I don't know how the app works or anything like that, right?
Sure.
Um,
Throw that book title out. What book was it? Or I mean, if you think it's worth like
no, everyone, it's like, dude, this is like the
the
first
one?
book on
Okay.
infinite banking.
Okay. Oh, is it? Does it have a red thing on the cover? Is it black?
Yeah, become your
Banker.
own
I know what
banker by
some super old dude.
Nelson Nash.
What's his name?
Okay, so here's the book: Becoming Your Own Banker.
Yeah.
R. Nelson Nash. The letter R. Nelson Nash. So that's the book I read. I think the book was good, but I think the YouTube videos of these IBC influencers are better. They explain it much better. So that's where you can do, I guess, more.
Yeah. I just like books. I like to like highlight and I can like tab and refer back easily. I mean, you can always rewatch the video, but which is what I have been doing. But you just laid that out, I think, pretty well. And you always give good like numerical examples where you can kind of like follow numbers. And I always even learn stuff too, like just with our discussions. So I think it's awesome. Dang, there was something I was gonna say. There's a lot of things I was gonna say while you were talking, but so do you think? So for IBC, if you had to say, this is kind of a bad question because I guess it can be personalized, like what you use it for. But what would you say is the number one purpose of IBC, typically speaking?
Oh, typically speaking, I think
obviously it can
it's
be different.
I think number one will be to buy a car.
Really?
Because a car is one of those things that, yes, you can drive around for 10 years, but like realistically, the average American is probably getting a new car. What would you say, 4 to 6 years?
Yeah, before 10. Well,
Yeah,
before 10 years.
like
For
we'll
sure.
say like maybe like 5 to 6 years or something
Buddy
like
got a new
that.
car yesterday, actually. Yeah.
Hey, who?
My buddy Cam.
Oh, okay. I was gonna say, I thought you said you got a new
just
car.
my buddy.
Oh, okay.
No.
And then with a car, like it's in the range where infinite banking, like you don't need to wait 20 years to utilize infinite banking. Like if you get a good chunk, like you could probably start using your infinite banking like year 3 to purchase a vehicle. And at that point, every time you're done with a vehicle, your loan would have been paid off already, and you can go buy a new one and rinse and repeat. And that's good because I'm in the camp of like I don't like debt personally, which is which is counter to this whole IBC concept because you have to use debt from your policy as a loan to grow it even further. And thinking about opportunity costs, like opportunity cost is like where if I have 50K and I can go buy a whatever brand new car that I want, or if I have this IBC concept loan, I can take out the loan, pay for the car, and have that 50K to invest. Because at that time, the money is doing more for you, right? Because, and this is like, I love talking about opportunity cost because like it's something that we don't necessarily talk about too much. And it's more on the pure mathematics side because I do want to say, having no debt is just easier on your mind. Right. But if you want to maximize the amount that you're getting without doing any extra work,
you have to.
Then you have to taking out the loan that goes back into your account eventually, and taking the money that you already had that you were gonna pay for a car anyway, and to go invest that. Like you have two money pots working for you. Whereas if you didn't take out the loan, you just pay for the car. The 50K is gone. And it's not growing for you. It's actually decreasing because car decreases in value very rapidly. So I think car is going to be a very popular thing that IBC is used for. Another thing is like, I think I wouldn't use it for short-term bad debt. Short-term bad debt, I'm thinking about like credit card debt. I guess student loans isn't necessarily short term, so maybe not.
It's definitely not short
I'm talking
term.
like personal loans, and credit card. That's probably the big two. I wouldn't use it for that. And
Okay.
because it's too short term. Like if you have money to invest into your IBC, like go pay off your freaking credit card loan. Like it just
Yeah.
like go
Right.
take care of
Just
that
do that
first.
instead. Yeah.
And for those ones, there is a thing called velocity banking, which I'm not going to get into because again, it's another 3-hour topic.
Throwing a whole concept.
But it's similar to how the money flows with an IBC, but instead of using a whole life insurance, you just use a HELOC. So you do have to be a homeowner to utilize velocity banking. And there's velocity banking videos on YouTube everywhere. So if that's where your situation is, like I would go look at velocity banking first and then come back to infinite banking later after your debts are taken care of. But also with infinite banking concept, I think it's great for longer term loans, majority of them being a car that we talked about and a mortgage. And because mortgage loans are amortized compound interest, whereas the infinite banking loan are simple interest, I think like I did the math once. I believe on a 30-year note, if you use infinite banking concept, but with it, I don't exactly remember the numbers I used, but I remember getting like 22 years without changing any payment. So you're cutting off 8 years out of the 30, which I think is pretty huge.
Oh no.
And
objectively, yes.
Yeah. So that, and again, I keep saying this, but the interest goes back into your account to grow your cash value.
It's like it's one of the biggest perks.
Yeah. So that's what I think majority of IBC, I guess, users would be using it for. But again, with the mortgage, like it's such a large value. Like, average home values are like 400 something.
Yeah, right.
So it's going to take time before your IBC cash value goes up to that amount to be able to borrow from it.
Right. Well said. No, you actually dove deeper in that question than I was anticipating. So when asked like what was it used for? It sounds like a generic answer would just be probably long purchases, or excuse me, large purchases, but like you said, pretty much for maybe good debt though, not bad debt, which we didn't necessarily define, but pretty much like a debt if you're not making money. Well, I mean, buying a car, you're not.
Yeah, I don't want to say buying a car is a good debt, but
that's not a good debt. But
one of the, I don't want to say unavoidable because people, drive around the beater for like 20 years and it's good for them. That's more in the camp that I'm in.
I'm trying to be it. Yeah.
Yeah. But honestly, if you have an IBC running, it might make sense just to, buy a car like nothing crazy, like every 7 years or something. So you can just
utilize the
or some. I think car loans go up to 7 years now. I could be wrong, but you could have it in a cycle where like on the 7th year you buy a new car, but then your loan would have been paid off by like 6 or 5.5 or something like that. Mm-hmm. So you're ready to deploy your cash again.
Yeah.
And then it's, I guess in that case, I'm not saying if you spend more money, it's gonna be better for you overall. Right. I'm not saying that, but it's just something that you get to enjoy. It's not all about money. It's like you got to use the money somehow, right? Like, and I think it's like as an adult, like a car, it's just like a nice toy that you're gonna play with every day. So I don't think if you're not like buying one every 2 to 3 years, I don't think it's like a bad thing to keep buying one if you have the money.
Possibly. And I think a common theme I'm hearing in all this too, or I guess just something kind of ironic that I want to tie back in is, we're talking about these debts that are typically long-term: mortgage, typically 15 to 30 years, car note, typically, I don't know, 4 to 7 years, depending on whatever. And then you also stated earlier that IBCs, are used for retirement as well, which is interesting because early in this episode, you said that, they're pitched as get rich quick, which is just, now that we've dove in a little bit, I think is so far. And now we can actually speak to why it's not get rich quick. And this is another case of something you need to pour into. And I would argue, we've talked about multiple times. I feel like there's an episode where we harped on specifically, though, starting, I would say, endeavors maybe like this, or just any retirement plans or long-term savings like earlier. And this one may be nuanced because unlike a lot of savings or things you can start early, if you just want to start savings or investing, you can throw in $100, $300 a month, whatever. This does require a actual amount to work to cover the premium, and then maybe overfund it so you can build up that cash value. So this you may not be able to start so early or so young because you need a certain base salary or certain income, etc. But nonetheless, if you are in a position to start earlier, I think this is another example of how much you can just fund that cash value and how much better your retirement can be, or how many more times you can draw from or pull loans from that cash value to use over the span of your life. So yeah, I just had to highlight the point how this is so far from a get rich quick. But if properly structured, like you said, a super useful tool. Something I think is very cool and that I hope to implement someday. Honestly,
Yeah,
but yeah, I
even
just
so. Okay, let me ask you, like, why, in very particular, like, give me the details. Why aren't you? Why haven't you started
okay.
IBC? Because we both agree that it
Yes,
is something good and we're supporters of it.
right.
So why not take the
Great
first
question.
step?
So, right, we just talked about the premium, how it's going to be a certain amount. And I'm actually in a transitioning period of my life where I'm going to be exiting one career field and hopefully into another. So I don't want to commit to a monthly payment where I'm going into a situation where my a monthly income, my salary is going to be changing. So I want to wait till I'm settled in that post transition period. So that's reason one why probably the biggest reason why I don't want to do this now. I mean, shoot, that's probably the main reason. Yes, probably because I don't want to commit those months, because, like, I mean, once you're in it, I don't know, like, you're locked into those payments,
Yeah, you're
and that
locked in.
yeah,
You
you're
are
locked in.
locked
So
into
this
those
isn't
payments
yeah.
until I don't want to. Again, I don't know
Yeah,
the
I don't
exact
know.
details, but down the line, maybe like 10 years or so, it's around there.
Mhm.
The dividend that you receive will cover the annual premiums that you have to put in, so you don't have to put in any more money.
Right. And
But
another
until then, if you stop a payment where like you doesn't cover the premium, like you wasted everything.
right.
Yeah. So
And and then I guess the
yeah,
next big reason would be, you kind of said you have to. It's gonna take, depending on the numbers. I can't put a specific year to it, but probably in the best case, I don't know what, 4 or maybe or more years for this to be. I don't know if lucrative is the right word, but to make sense
yeah,
to actually draw from it. So again, it's one of those things you don't reap the benefits right away. It's a slow burn. It's a long process. So one, I don't want to commit to something right now when the near future of my income could change. And two, I don't want to commit to something where I'm not going to see the benefits in the near term. Just at this point in my life, those are the two. I was trying to think of the other. Those are the two, like, big reasons that's stopping me. Now, if I was in a position where I wasn't going to make any big purchases, which I have a couple on the horizon, and I could just give some steady cash this over time. Like I said, I think it's a great vehicle, but that's what's stopping me right now.
and
Yeah.
I completely agree with you. Like you have you don't have to be. The people on YouTube, they'll be like, "Oh, you can just do with whatever you want to do. Like put in the minimum premium, put like $50 on top of it. Just with that, you're just not gonna utilize that money.
It's like
Like
you're not maximizing the
yeah,
concept.
like
Yeah.
after 10 years, you have like, let's just say, I don't know, 70K, right? Like
Yeah.
it's too slow.
Mm-hmm.
It works better, obviously, with any investment, any
Yeah. If
compound
you have more.
interest
Yeah.
vehicle that you want to have more. So that is definitely a very prominent con, and that's one of the reasons why I haven't either. Because my priority is my real estate, and that has been sucking a lot of cash for me too. Because I want to keep my savings in place for the real emergencies.
Heck yeah.
And I just kind of laughed when you're talking about it because everything you said was, I mean, one of the big things is like, oh, you have to wait a while. And I don't know how people are twisting those things into making it seem like a get rich quick scheme. Like they don't say that. They don't say it on like shorts and YouTube
But that's
videos and whatnot.
kind of reads.
But then they say like, oh, you're gonna get so rich, blah 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 blah. Like you kind of think of like, oh, I'm gonna get rich. Like it can't be like that long. But then you look into
they know the buzzwords to kind of exactly
10 years,
lure you in.
Yes,
exactly.
So that's one thing, and the premium. I wouldn't recommend this to someone that is in a bad financial state or that's not knowledgeable about, I guess, money in general. Because like the flow of money, understanding money is like they don't teach that. They don't teach that. And if you're gonna just have like an IBC account and not take out loans, like that's also wrong. Because you're just like, if you're gonna only get 6%, might as well just put it in the stock market and get 10. Right. That's what averaging. So it just doesn't make sense, and you just got to be comfortable with, I guess, being able to take out loans, make payments, arbitrage that money, make that money work for you. And if you don't know how to do that, it's probably not going to work. And then you would have wasted a lot of money and a lot of time. And then in simplicity, if you want to make it simple, like just dollar cost average into the S&P 500 index fund, those people will do just as well. I'm sure. I don't say just as well, but giving a low knowledge base of money, they will do just as fine.
Yeah, I agree. We kind of talked about this before, just getting on the mic before the episode, how originally to me, Infinite, and I kind of want to talk about it and probably have you speak on it. We're talking about the IBC conceptually, how you're pretty much cutting out the bank, taking loans from yourself. But like you said earlier, and I kind of tried to, I guess, highlight, that interest being paid back to yourself is a huge piece. And, originally I was wondering like, okay, the concept of borrowing from your own assets, taking from yourself, paying yourself back is great. But why is it just focused on whole life insurance and not borrowing from other, assets people have? Because there's plenty of like, there's plenty of there's other ways to borrow against your own stuff. So can you speak to why IBC specifically is the use of whole life insurance?
Yeah. And I think the easiest comparison, at least I made in my head, was 401k loan. And 401k loan itself is not like a very talked about strategy.
No, definitely
in
not.
Just money in general. Oh. And I will forever take out 401k loans, probably till I die, because until I work, I guess, because at that point I wouldn't. Yeah, after you stop working, you're not gonna be able to pull it out. But as long as I'm working, I think I will always pull out a 401k loan. Pull it out, probably pay back everything over 5 years, and then pull out a new one, because the money that you pay back in interest, I will give you exact, I'll give you the exact rate that I took it out for. Because I took one about a year and a half ago, maybe.
Sure.
And the one limitation with a 401k loan is that you can only take up to half of what's in your account.
Yeah.
Versus like the high 80s to 90% in the IBC structure. And if you have over 100K, you can only take up to 50K. So if you have 100, half of that is 50. If you have 102, half of that will be 51, but you can only take out 50.
Take 50.
Yeah.
I don't think I knew that last piece.
And I'm trying to pull it up. I'm trying to stall.
No, you're good. I was going to I was close. I was thinking about taking. What was I taking? I was thinking about taking one out recently. I know you had before, and I didn't. We briefly discussed it, but it doesn't seem like a terrible thing to utilize.
No, so this is so slow. Okay, finally came up. So I pulled out the 401k loan. The interest that I'm getting charged is 9.5%, which is a pretty high interest loan.
It's up there. Yep.
But I looked at the numbers and I said, hey, I can't afford it. And then the money is more valuable to me now than sitting in my 401k account. But the crazy thing about the 401k loan is the 9.5%, I still have to make the payments, but that goes back into my account. And the way you pay back the loan is you just buy back the asset that you're invested with. So you're going, if your 9% is like $300 a month, let's just say, you're making your other monthly 401k contributions, right? With the employer match. And on top of that, you got to get $300, but the $300 is going back into your account. So you're not paying it to the financial institution that you borrowed from, because you're not borrowing from them. You're borrowing from your funds.
Yeah.
And the reason why you can't use IBC with 401k loan or 401k or any other vehicle, because something's going to give, whereas IBC covers everything. But for example, for the 401k loan is first, it's not guaranteed to go up in value. Where like stock market, we have, it's generally going to go up, and over a long period of time, it's going to be about 10% average. But we do have recent history where there's a crash or a recession and stock values go down. So that's one thing. And another thing is there's a limit on the 401k loan. So you can go up to 50, right? But then if you're putting a good chunk in your IBC, you're going to surpass 50 very quickly. So that's why you can't use 401k loan as an IBC vehicle. And again, like you can't pull out a 401k loan if you don't work, right? You have to be funded. You have to be sponsored by your employer. And then we were talking about, okay, why can't you use it as a HELOC? I think you can use it with a HELOC, I guess. But there's another couple things that kind of give is, one, housing values don't always go up.
Yep.
Right. And the second thing is, you have to have a house, which is an expensive,
which is a huge
purchase. And you can, with a HELOC, you're not paying as high of an interest rate as a personal loan, but it's still, like 6 to 9%, we'll say. So you're losing that 6 to 9% in forms of interest to that bank that you borrowed from.
And I think that's a huge one for that. Yeah.
So, and we can talk about other things, but the catch-all that covers everything is IBC. And I think that's why you have to use like a whole life insurance that's designed for IBC. Because if you just take a regular whole life, it's not a good product. It's really not. That's why generally the accepted notion within, I guess, financial advisors or just the finance community is, don't do whole, just do a term life insurance and just invest a difference into whatever, or invest or save or, spend whatever you want to do with your money.
Yeah.
And that's what I do. I mean, that's what I have a term. I have a term life. I have a term life for $1 million, and I think I pay $122 a month. And if I wanted $1 million on a whole life, like that would have just been much higher in cost. Probably triple the cost.
For sure. Easily. Nice. Okay. So what I'm hearing in summary is IBC is IBC, using the whole life. You can always take from it, right? Like you said, not employer sponsored. The interest rate goes back to you.
And it's low.
It's not capped. We didn't even talk. What were some other
another thing is because it's a simple interest loan, like similar to a HELOC, you don't have to pay down your loan. You just have to pay the interest on it.
Yeah.
Right. So that's a big thing too. With a compounded loan, like an amortized loan, you have to pay the interest on top of the principal. That's how it goes down and you're on a schedule. And if you just like going through something, it's like you have a couple bad you have a bad quarter or something, like a 3-month period, you just have to pay back the interest on it. That's it. And it's not that high. It's like 4 or 5% or whatever.
Yeah. And I think didn't you say like the loans taken against it are tax free?
Well, yeah. So loans in general are tax free.
Well, yeah.
You can't like, just by definition of a loan, you can't tax on borrowed money.
True.
And also the dividend, that 6% that you get, it's basically, so think about insurance companies, right? This whole life insurance company. You have to pay out the death benefit, like that. It's just
That's a guarantee,
part of the deal, right?
Guarantee.
So how the insurance company works is they have a different pot of money allocated, given statistical, probabilities of these are all the policyholders, and this is the amount that we have set for the death benefit for the year. That's the money, right? But let's say only like 70% of people that that was allocated to die, I guess in this case, they only 70% died, right? So 30% will be in excess of money, right?
Mm-hmm.
So they distribute that to the account holders, which these whole life insurance they're called mutually owned. So if you're an account holder, it's like owning a stock of that company. Being an account whole life insurance holder, you own part of the company, so therefore they give you that money back in terms. They call it a dividend, but it's pretty much like a refund. I get, right? And also they're making investments on their as a company, and then they're gonna get their money, and that's how they're able to pay these they call it dividends. Think of it as a refund, but because it's a refund, it's tax free, and they grow.
Nice.
And it's crazy. Like I don't always throw around the term guaranteed often.
You got to be, especially in the
because space. I mean nothing. I'm on the camp of like nothing is guaranteed, and so with the IBC, like yes, I think I am correct in saying nothing is guaranteed. The company could fail, but these companies, I think there's like a, I don't know the names, but I heard people call it like the big 3 or big 5. So I'm sure there's like a few prominent companies in the space, but one of them's like they've been paying dividends every single year since like before the Civil War. It's just like, dude, it's great. Like I am willing to bet that they're gonna pay their dividend next year.
Yeah.
Yeah. And one other plug that I want to throw in is, even if let's say you learn about it, right? And if you really learn about it, I think majority of people are going to realize that this is a really good investment vehicle. And even with that, you come across hurdles in your life, and you're like, I just can't do it because of these restrictions I have in my life, whatever.
Sure.
But the crazy thing is, when your child or children are born, you can take out a policy for them like 2 weeks after you're born or something like that.
Yeah, up to 2 weeks, I think.
So even if you can do it,
2 weeks, yeah.
Yeah. Even if you can't do it for yourself, do it for your kid, and their premium is going to be much, much, much lower, right?
Yeah.
So I'm sure I don't think you do 1 times 15, your monthly premium is 15. I don't know if that's that low. There might be some exceptions, but like the idea, the concept behind it, the message behind it is their premium is going to be much, much, much lower than yours. So, and also like they have like a 30 year head start than you, right? Because you're, by the time you have kids, let's say you're 30, your kid's born, and they're 0, obviously. So they just have 30 more years of compounding that they're going to experience.
Yeah.
So if you're tight on cash because you have to have a good amount into the IBC, I could probably cut that number that you were thinking about in half and just do it for your kid, and then they're gonna probably thank you for rest of their life.
Yeah, they're better.
Yeah. So even if you don't take action for yourself, like I think having that knowledge is beneficial in helping your, we talk about generational wealth. This is the perfect example of generational wealth.
Facts. On top of them getting your death benefit.
Yeah,
Well,
I
that's.
mean,
I
yeah.
mean, if you did it for you, if you don't and do it for them, I guess you wouldn't have yours. But yeah, yeah. It just sounds like for me, it's like a very stable vehicle because this is one that I guess kind of like you said, where you compare like your 401k or whatever,
Mhm.
TSP for me can go down with the market. Like it kind of not supersedes the market, but it will always not guaranteed, but to grow, but it's just way more stable. And then we were talking about this before to use this, I guess, like catchphrase. I think it's cool because it keeps the money in your quote unquote wealth ecosystem. Fancy
Yeah.
word, but it's just saying like, you always kind of in my head, I equate that to like you always have the control over kind of like your money. You're minimizing where it goes, which is I, I think one of the underlying themes of this concept is like you are cutting out the bank. Like it
Mhm.
stays within your kind of control. So between that stability and that like ownership of your own dollar, I think yeah, those are the two reasons for me that are like just very attractive for this concept, I guess.
Yeah.
Trying to think of what some other cons maybe. I know we were talking about Dave Ramsey before. I don't know if we
Yeah,
want
I
to.
think I think we pretty much laid out the cons, but just to
Yeah,
go over it, it's like first, it does take time. And the
mhm.
less that you put in, the longer time it's going to take. And the more you put in, obviously you can start using it much quicker, but just general concept, it's going to take time. It's
Yeah,
definitely not you're not going to
yeah.
be taking max benefit like year 3. So that is a one con. Another con is like you're going to be living that debt cycle. And that's not necessarily a bad thing, but just like a mindset shift because you think of debt as like a bad thing.
Mhm.
But then debt is an asset to banks.
Oh,
Debt is a
100%.
liability to you, asset to
Dude.
banks, and that's how they make their money. So it's not inherently bad.
Mhm.
You can use it properly to make money. But the mindset shift is probably one of the biggest cons because like you've been receiving money ever since you're like conscious, right? From birthday gifts or from your parents or whatever. And you have a solid understanding of what you think how money works. It goes from someone else to you
Yeah,
through a bank account and you go spend
yeah.
it. Like you got to change that mindset, which could be a very hard thing to do. Oftentimes, like it's much harder to, unlearn something
Unlearn.
instead of
Yeah.
trying just learning something brand new. So I think that's one con. We talked about the capital requirement. Like the later you get
Mhm.
started, the more premium is going to be. And then like I said, like if you don't have good amount to put in, I would probably advise against it. And yeah, and then having enough knowledge to once you take out the loan, where are you going to use it?
Yeah.
So there is definitely cons around it, and then it's definitely more of a higher end strategy, I guess.
Mhm.
But then I mean that's why the rich people use it, right?
And probably why we don't hear about it all that much.
Yeah.
Yeah. Well, yeah, 100%. A super informative, super good to talk through. I would love to get somebody on that's like
Yeah.
without, you know what I'm saying, without just kind of navigating it without telling all their ins and outs, obviously their nitty-gritty personal details, but this would be a good one to kind of really see how people have leveraged this concept, how people got started or whatever. Yeah. We kind of answered the question I was going to ask you. You kind of already brought up. I was going to say, like why haven't you used it or whatever. So I think that's cool that we kind of touched on that. But something I with the right structure and whatnot, hope to take advantage of someday, if not for myself, maybe for like, a child when that day comes. But
Mhm.
all in all, yeah, I think it's a super good tool. I think you kind of detailed that, like laid it out very well as well. So I'm good, bro.
I appreciate it. I thought it did a terrible job. I thought it sounded like I was rambling. I'm sure I was. But
it's a very that's why it's just good to kind of talk, and I feel like it's a very digestible manner. We're not like trying to pitch anything. Again, it's just food for thought. And to bring it
yeah,
full circle, it rebels. I mean, kind of what you were saying. It rebels traditional thought on, I guess, just historical banking, or even just normal flow of money. I guess kind of both.
yeah,
Just within this concept alone. So I think it's just a natural rebel concept in itself. We didn't even have to like go outside the box. Just pretty much talk about the concept, which I truly do believe in. So
yeah. No, that's good though,
um,
because at least everyone that I watched on YouTube, like they are selling the whole life insurance stuff. So they are salesy oftentimes.
yeah, yeah,
And yeah, like I said, I have zero care if you do IBC or not.
facts.
We just want to talk about it, right?
Yeah, it's just a cool concept that it's not really talked about. Sweet. All right, you good?
I'm good.
I'm good. Thank y'all for tuning in, and we'll catch y'all next week.